Imagine a time before money, a time when the concept of currency was non-existent and people had to rely on a system of direct exchange. People bartered, trading goods and services directly. This was the primary method of commerce in ancient times. A farmer might trade grain for tools, or a potter might exchange pottery for food. This system, while functional, had significant limitations. What if the toolmaker didn't need grain? What if the potter already had enough food? The barter system required a double coincidence of wants, meaning both parties had to want what the other was offering. This inefficiency led to the need for a more flexible system. Enter money. Early forms of money, like coins, emerged. These coins were made from precious metals and were universally accepted, simplifying trade and eliminating the need for a double coincidence of wants. These early transactions sowed the seeds of modern finance. With money, people could trade more efficiently, save for the future, and invest in new ventures. As the use of money became widespread, people needed safe places to store their coins. This led to the creation of secure storage facilities. They also needed ways to borrow and lend money. Lending practices began to develop, allowing individuals to borrow money for various purposes, such as starting a business or buying land. This led to the development of early banking practices. These practices included accepting deposits, making loans, and facilitating trade. These practices emerged in various parts of the ancient world. Different civilizations developed their own methods of banking and finance. From Mesopotamia to Egypt, societies developed sophisticated financial systems. These systems included the use of written records, contracts, and interest rates. Temples often played a role in these systems. They were seen as trustworthy institutions and provided secure storage for valuables. They provided secure storage for valuables such as gold, silver, and important documents. People trusted temples to keep their wealth safe. They also acted as intermediaries in financial transactions. Temples facilitated loans and acted as guarantors for various financial agreements. These early practices laid the groundwork for the development of modern banking institutions centuries later. The principles of safe storage, lending, and financial intermediation that began in ancient times continue to underpin our financial systems today. In ancient Mesopotamia, temples were not just religious centers. They were the heart of the community, serving multiple roles beyond their spiritual functions. They were also economic hubs. Temples had large storehouses, which were essential for the community's survival and prosperity. These storehouses were ideal for storing grain and other valuables, such as precious metals and important documents. The security provided by the temple walls made them the perfect place for safeguarding these assets. People began depositing their assets with temples for safekeeping. This practice was not just about protection, it was also about trust. The temples were seen as trustworthy institutions managed by priests who were believed to be in favor with the gods. This practice marked an early form of deposit banking. By entrusting their goods to the temple, people could ensure their assets were safe from theft and natural disasters. Temples also played a significant role in lending. They were not just passive guardians of wealth, but active participants in the economic life of the community. They had accumulated wealth through donations and religious offerings. These offerings were often substantial, as people believed that giving to the temple would bring them favor from the gods. With this accumulated wealth, temples could afford to lend out a portion of these resources. This was a way to put the wealth to use, rather than letting it sit idle. Temples often provided loans to farmers and traders. This supported economic activity by giving people the resources they needed to plant crops or trade goods. These loans were crucial for the community's economic growth and stability. These loans were not always interest-free. The temples needed to ensure that they could continue to operate and provide services to the community. Temples often charged interest on loans. This interest was a way to cover the costs associated with lending, such as the risk of default and the administrative work involved. This helped to cover the costs of administering these financial activities. The temples had to manage records, ensure the safekeeping of deposits, and oversee the repayment of loans. The practice of charging interest has remained a fundamental aspect of banking to this day. It reflects the enduring need to balance the benefits of lending with the costs and risks involved. In this way, the temples of ancient Mesopotamia were more than just places of worship. They were the early precursors to modern banks, playing a vital role in the economic life of their communities. Their multifaceted role in society highlights the interconnectedness of religion, economy, and community in ancient times. The legacy of these early financial practices can still be seen in today's banking systems. Fast forward to medieval Europe. Trade flourished along the Silk Road and other trade routes. Merchants needed ways to finance their ventures. They also needed safe ways to transfer money across long distances. This led to the rise of merchant banking. Merchant banking families like the Bardi and Peruzzi rose to prominence. They provided loans to merchants and rulers. They also developed innovative financial instruments such as bills of exchange. These bills allowed merchants to settle debts without physically transporting large sums of money. These early bankers faced considerable risks. Loans to rulers could be risky. Rulers might default on their debts. This could lead to financial ruin for the bankers. The risks highlight the challenges inherent in early banking. Section 4. The Medici Dynasty Masters of Finance. In Renaissance Italy, the Medici family emerged as financial titans. They established a banking empire that spanned Europe. The Medici Bank financed trade, funded artistic endeavors, and even bankrolled the papacy. Their influence was vast. Cosimo de' Medici, the patriarch of the family, was a shrewd businessman. He expanded the Medici Bank's reach through strategic partnerships and investments. He also cultivated close ties with powerful rulers and the Catholic Church. The Medici family's banking practices were innovative for their time. They developed double-entry bookkeeping, a system that revolutionized accounting. This system made tracking income and expenses more efficient and accurate. It is still widely used in accounting today. Section 5. Birth of central banks, stabilizing economies. As economies grew more complex, the need for centralized financial institutions became apparent. The rapid expansion of trade and commerce, coupled with the increasing complexity of financial transactions, highlighted the necessity for a more organized and regulated financial system. Governments needed ways to manage their finances, control currency, and regulate the banking system. Without a central authority, the financial landscape was chaotic, with multiple currencies and inconsistent regulations creating confusion and instability. This led to the establishment of central banks. These institutions were designed to bring order to the financial system, providing a stable foundation for economic growth and development. The Bank of Amsterdam, established in 1609, is considered a precursor to modern central banks. It was one of the first institutions to offer a centralized clearinghouse for financial transactions, which was revolutionary at the time. It acted as a clearinghouse for bills of exchange, facilitating trade and reducing the risk of fraud. By providing a trusted intermediary, the Bank of Amsterdam helped merchants conduct business with greater confidence and security. It also helped stabilize the Dutch currency. By managing the supply of money and ensuring its value, the bank played a crucial role in maintaining economic stability in the region. The Bank of England, founded in 1694, further developed the role of central banking. It introduced new financial instruments and practices that would become standard in the industry. It provided loans to the government, managed the national debt, and issued banknotes that became a widely accepted form of currency. These banknotes were backed by the bank's reserves, giving them a level of trust and reliability that was previously unheard of. It set the stage for modern central banking. The principles and practices established by these early institutions laid the groundwork for the sophisticated financial systems we have today, ensuring economic stability and growth. Section 6. The Industrial Revolution fueling economic growth. The Industrial Revolution brought about unprecedented economic transformation. New technologies such as the steam engine and the power loom led to mass production and increased trade. Banking played a crucial role in financing this growth. Banks provided capital for entrepreneurs to build factories, purchase machinery, and hire workers. They also financed infrastructure projects such as railroads and canals, which facilitated the transportation of goods and raw materials. The rise of industrial capitalism led to new banking practices. Joint stock banks emerged, allowing investors to pool their resources and share in the risks and rewards of banking. This innovation fueled further economic expansion.